much, Nimesh, for that. Let's invite Abhiram Eleswarapu, the head of India Equity at BNP Paribas India. He's with us on the show now. Abhiram, afternoon, and thanks for joining in. Your Nifty target of 19,650 doesn't leave a lot of upside from current levels. What is it that you expect?
Thank you for having me on the show, and Happy New Year to all of you.
Happy New Year.
In terms of the Nifty, thank you. In terms of the Nifty target, yes, the upside is over a 12-month period, and it factors in about a 9 to 10% potential upside. But having said that, as a house, we've taken a view where we are actually quite cautious on the markets in the first half of the year. So I wouldn't actually be surprised if we first see a correction and then maybe a bounce back later in the second half. So therefore, this is what is factored into the Nifty target.
Abhiram, the earnings season is upon us, and I guess now numbers will be kind of closely watched. If you remember last quarter, maybe except banks, where we saw not upgrades but earnings estimates were met. Most other sectors saw a little bit of pullback in terms of downgrades, basically, earnings downgrades. What's your expectation broadly this time? It's kicked off with TCS already, and I'm assuming you've heard what they've told us. But what is your sense?
Yeah, I see the trend of the last many earnings season. We've had roughly half of the companies beating estimates, and maybe about 30% kind of in line. And in the last earnings, the ratio of cases was a little bit higher than normal, and that was a result of elevated cost pressure more than anything else. And I think that kind of a trend may continue in this quarter as well. So broadly, you may not have a massive change in the earnings estimates, because even after the last earnings, we just saw maybe at an aggregate level a couple of percentage points downgrade in earnings. I think something similar may happen this time. What I'd, however, look out for is any sense on 2 points. One is how the rural economy is shaping up, and secondly, how is the capex cycle looking? Because these two are critical for the overall India view for the full year.
Okay, all right. Hi, Abhiram. I wanted to ask you about a couple of other sectors. The insurance space, that's been actually an underperformer. 12 to around 18 months, that's been underperforming. But in the last maybe couple of weeks, the last fortnight or so, we're seeing some traction out there. Do you believe that now the sector is set to do well? That's the stock price movement. Under-penetrated, we get that point. But stock prices will start reflecting that?
Yes, I do think so. In fact, I recall being on your show earlier a couple of months ago saying that we are positive on insurance from a structural standpoint. Like you mentioned, it's an under-penetrated market, India, and the stocks haven't done much in the last couple of years or so. Valuations are still supportive, and if you see the latest data that's come out for December as well, looks pretty decent, especially the large private insurers are doing pretty well, and I think those market share gains will continue. So it's a space that we like, not just from a near-term perspective, but also over a long-term structural basis.
Abhiram, you have to make certain assumptions, right, when you have to come out with a call in the sector. So when it comes to IT, where you have a counter-consensus constructive call, so you're basically bullish on technology, what are the assumptions that you're making when it comes to the kind of tech budgets, the kind of spending that we are likely to see from the clients of IT services company, and the growth rates that we could see? Because the street is currently penciling in a significant decline in the growth rates.
Yes, I think growth rates will probably fall compared to what we've seen in the last couple of years. But having said that, I think tech spending broadly is still healthy at an enterprise level. And I think where we differ from the street on 2 counts. First is that we think demand will be a lot more resilient than what the market is expecting. In other words, the fall in growth rate will not be as sharp as people think. That's number one. And number 2 is that the pressures on costs also will start to ease going into the next few quarters. And that's because attrition will probably start to come down. And broadly, when you enter in a situation like this, a recessionary environment, other costs also start to come down, such as travel, etc. So broadly, I think that the margins may not fall. If anything at all, they may actually expand. And demand will overall remain resilient. And over the last 1 year, IT has underperformed quite significantly. most companies offer dividends. In some cases, there are also the case of buybacks as well. And therefore, I think that it's a reasonable sector to be positive on, at least on a relative basis for this year.
You know, Abhiram, you like the diagnostics space, right? Which ones in particular? Because some of them have really been sort of smashed quite good. You know, Metropolis comes to mind, even names like Dr. Lal, etc. Anything in particular?
Yeah, I mean, as I'm very difficult to go into individual names, but as a space, what we really like is we're looking at this as a bit of a dark horse. You see, the sector's underperformed significantly over the last 12 months or so, maybe even longer than that. But having said that, I think the market's now understood that the COVID benefit that they had was a one-off and it's beyond them. And in the past 4 to 5 months or so, you're starting to see competitive pressures come down, especially from private equity listed private players, for example. And you're starting to see the testing levels also starting to go up. And from a longer term structural perspective, obviously, the urban Indian is getting more health conscious and so on. And so I think proactive testing will also continue. So in short, I think the space is more a call on a combination of a mild recovery combined with the significant underperformance that we've had. And it's a dark horse. That's the way I'd put it.
Okay, all right. Abhiram, it seems your contra-constructive view on IT seems to be playing out at least for the last 1 hour or so. TCS, as we speak, has moved to the high point of the day. It's recovered considerably from the low point of the day. So that's good news. There is some caution on the IT space, but I guess we have taken your view on board. Before we let you go, you're also pretty positive on Telecom, as well as a couple of media stocks. Could you name out a couple of there? I mean, from the Telecom space, there's one player that's struggling. There's another one that's into other businesses as well. And there's a core telecom player. So which one are you positive on from the telecom space? And if you could give us an insight into media stocks as well.
Yeah, I mean, on telecom, the call here is that the space is going to consolidate going further. You'll see market share gains for the large two players. That's the call. But also a bigger, kind of observation here is that telecom services are now core services in that they're almost like staples. And the consumer, we think, will be more receptive to price increases. And we expect more price increases over the next few quarters or so. So in short, you'll probably see a resilient space with reasonable demand and price benefit as well. So that call on telcos. On media, I think the real story here is that you have about a couple of names where cash flows are quite decent and also the dividend yields are decent. Sector's not done very well. In case you kind of want to factor in some kind of a rural recovery in the second half of the year, then that will also probably translate into increased ad spending. And that's one area that could be a catalyst for the space. So media, a couple of large names, and in telcos, a couple of the large two names. Those are the ones that we're looking at. Broadly, our positioning is quite defensive in the first half of the year. If you see, it's just the whole thing is about focusing on cash flows, dividends, and things like that. And as you get into the second half, maybe to add more risk.
Fair enough. That point is taken. Abhiram, do stay on. We have a few more questions for you, but need to slip into a break. But as we